How's everybody doing, guys? This is Bob Iacchino from Path Trading Partners, along with my co-founder, Mike Arnold. And this is another module in our series of technical analysis for cryptocurrencies. We're going to continue on a theme of moving averages. And we're going to talk about exponential moving averages in this module. So let me go ahead and get started. So moving averages come in a variety of forms, and this is not every type of moving average, but these are the main ones, the ones that are most used. The following are various types of moving averages. There's the simple moving average, the exponential, which is what we're going to cover in this particular module, the weighted moving average, the adaptive moving average, and the displaced moving average. Again, there's others, and there's specific ones that people have developed named after themselves, but these are the main ones that every trader would know of. In a different video, we covered the simple moving average. Please also watch that one in conjunction with this video. You shouldn't just watch this one, or honestly, you shouldn't just watch that one either. But in the meantime, let me turn it over to Mike to give you a little bit more background on the math behind the exponential moving average. Mike, it's all yours.
Thank you very much, Bob. So don't get hung up on this math, but this is sort of just interesting if you want to know the differences with the exponential moving average versus the simple moving average. Now, the exponential moving average does not weight each data point the same. The exponential moving average gives more weight to recent prices in an attempt to make it more responsive to current price action. So the formula is exponential moving average is the price times a weighting factor plus the prior value of that exponential moving average times 1 minus that weighting factor, where the weighting factor, in this case alpha, is 2 times the number of periods plus 1, where it ends the period of the EMA. So if it was a 10-period EMA, it would be 2 divided by 11. If it was a 20-period EMA, it would be 2 divided by 21. All right, and again, you don't have to figure all this out. It's just handy to know. So based on the prior equation, why is it called an exponential moving average? So you saw in the past equation, the past value of the exponential moving average is always utilized. This actually leads to an exponential effect. The prior equation can be rewritten in longer form like this, where n is the period that you're on, and you see the weighting factor. As you keep going, it gets squared, then cubed, and then it goes to the power of however many periods you're going to. So it actually has an exponential effect. And don't worry about this equation again. Just for point of knowledge, you can throw it out at cocktail parties. You can impress all your friends that you know something that most people don't know. Let's take a look at that weighting factor. Alpha equals 2 divided by n plus 1. So for a simple moving average of 10 periods, of course, each data point contributes 10% to the result. Why? Because you're adding all those data points, as we covered in the simple moving average video, and then dividing it by, in this case, 10. So each one would be 10%. For a 10-period exponential moving average, however, the most recent data point would contribute 18.18%. How do we get that? You can see alpha equals 2 divided by 10 plus 1, which gives us that 0.181818, which is 18.18%. So whereas in the simple moving average, it's contributing 10% for that data point, exponential is contributing 18% for that most recent data point. The amount the most recent price contributes to the EMA varies based off the length of the EMA. A 20-period EMA, the most recent data point, would contribute 9.52% versus 5% for an SMA. Because why for 5% for an SMA? Because there's 20 periods. Each one would contribute 5%. Again, you could just do the math of 100 divided by 20 gives you 5, so it's going to be 5%, versus the 9.52 by plugging in our data into the alpha equation gives us 2 divided by 20 plus 1, which is us 0.0952, versus 1 divided by 20, which gives us the 0.05. A 50-period EMA, the most recent data point, would contribute 3.92 versus 2% for the SMA. How do you get that? 2 divided by 50 plus 1 is 0.0392 versus 1 divided by 50 equals 0.02. So you can see, depending on the length of the exponential moving average, it does vary that most recent data point, but it always contributes slightly more than the SMA. So here, as you can see from the table to the right, the sum of the weights for a 10-period EMA does not equal 100%. Well, for a simple moving average, it does, because all your data points add up to 100. If you 10 times 10 is 100. If you add up all the bars for the exponential moving average, it only equals 86.6%. What does that mean? This is due to the fact that the prior data is always included in the calculation. So whereas the simple moving average, the old data falls off, the 11th data point would fall off once you got a new data point. In the exponential, it doesn't fall off. There's always some remnant of the prior data in there. So data never falls off. So even on a 10 period or 100 period or 1,000 period moving average, you always have all the data points in there. However, the farther back the data, the less and less important it becomes. Since the calculation of the exponential moving average relies on the prior value of the exponential moving average, the first data point is generally the simple moving average. You can't come up with an exponential moving average for the first one because it requires an input of the prior value. So to start off the calculation, generally most people who do it start with the simple moving average, and then after that initial data point, it starts to deviate. So to calculate the 10-period EMA for bar 11, we have the following equation. Alpha equals 2 divided by 11, which is that 0.1818. So the EMA is, you can just see it in this calculation. I'm not going to spell it all out, but it goes to 48.09. And you see the SMA on this table to the right was 48.02. So the most recent data point has a little more weight. And you can then see how they start deviating. The exponential moving average is probably the second most popular among traders and investors after the simple moving average. Many traders like it better than the simple moving average because of the fact that the more recent data is weighted more. This means that for the same length, SMA and EMA, the EMA will turn quicker. We've investigated the simple moving average in another video, so make sure you watch that one in conjunction with this one to get a better understanding of the simple moving average. But let's take a look at now the exponential moving average turning quicker. So we have an EMA in blue. Exponential is blue is a 21 period EMA. The simple moving average in red is a 21. So they're the same period, the same length, but you can see how the blue one turns much quicker than the red one. It reacts to price going up or down quicker, and you can see how it turns as price shifts, it rotates down and up much faster. Let me turn it back over to Bob to cover some of the common uses of EMAs.
Thanks for that, Mike. So as Mike said, common uses of exponential moving averages. So there's four major categories that most traders use moving averages for: exponential and simple, but we're discussing exponential, so let's stick with that theme. One way is defining trends. A second way is for support and resistance, depending on where price action is, either above or below the particular exponential moving average you're using at the time. Trade entries and triggers. When do I get into a trade? And trade stops and exits. When do I get out of a trade? We investigated the first two items in the SMA class, the simple moving average module, and we'll investigate the final two in this particular module. So I talked about defining trends and support and resistance as the simple moving average main uses. The exponential is a lot more common for the final two. So let's talk about EMAs and trade entries and exit. One of the ways that traders have looked to use the moving averages is with a crossover system. They look for either price to cross a moving average or for different length moving averages to cross each other. So different inputs, for example, a 9 and an 18 or something like that. These can be used for both systematic entries and exits. EMA trade entries with price crossing the EMA. This is a chart of Bitcoin. It's a 60-minute chart. And here we have an exponential moving average on the chart. It doesn't really matter which one this is because it's not particularly a system that we use. But here in the green line, you see an exponential moving average. Now, in theory, each time that price crosses through the moving average, this is price crossing the EMA. As price breaks through it or crosses the moving average, you would enter a short trade. That's one of the way that people use it on the downside. On the upside here, and you can see that with the red arrow. On the upside here with the green arrow, price stays below it, stays below it, stays below it. On the way back up, it crosses through, and you exit the short and enter a long. This is an example of price crossing the EMA as a system. Here you see it crossing below, and then this would be exiting the long and entering the short. Now, looks great on this chart. This is a trending market. But how does it look when a market is moving sideways? Well, it looks like crazy town. Okay, so here you've got price crossing and you enter a short. Then it crosses back above and you cover the short and enter a long. Then it crosses back below and you cover the long and enter a short. And on and on and on and on, all the way through to the right until you finally get this one that looks like you might actually make a little bit of money on. This is what it looks like when price is consolidating. And this is still Bitcoin. It's not a different chart. Okay, it's still a 60-minute Bitcoin chart. So you have to be careful when using this type of a system. As a matter of fact, it's not something that we recommend for traders to use. When you get into trending markets, looks great. When you get into sideways markets, again, it's crazy town. And these losses that you make getting chopped around like this tends to wipe out the gains that you make when you're in a long trending market like you were in the last chart. Now, two EMA crossovers. This is something that's used commonly. And this is, by the way, a lot of beginning traders, whether it's in Bitcoin or something else, or whether it's in cryptos or traditional markets, they always start out with moving average crossover systems. So here you've got, again, a trending market. Keep that in mind. But here you've got two different length EMAs on a 4-hour Bitcoin chart. Okay. So now the yellow crosses above the blue line. That's a long signal in an EMA crossover system. So here's your long signal. So now you get long, you stay long, all the way up until it finally crosses back down here. So now theoretically, you got long here, and now you're going to exit your long and get short. You can wait again for your moving averages to cross back over. So here's your short trade. Follows this path to here, all of a sudden gets over to here, crosses back up, you get out of the shorts, and you get long. Now this is focused on the EMA's crossing, not price crossing, okay? Because you see price crossing all over the chart, but you're waiting for the different length EMAs to cross. Now, is this a better system? It is if we're trending, because again, what happens if we're moving sideways? There you go. Moving average cross, long. Moving average cross, exit the long and go short. Go all the way to the right here, crosses again. You exit the short and go long. 2 bars later, crosses and you exit the long and go short. Same sort of choppiness. It filters out quite a bit more than when price crosses the EMA, but still the EMA crossovers in sideways markets. And again, this is a Litecoin chart. So this is cryptos, right? When the market, when the EMA crosses and you're exiting in a sideways market, entries and exits based on the crossover, you get chopped up and you wipe out a lot of your gains. In case you've never been a trader before, chopped up is what happens when you lose your money through multiple trades. We call that getting chopped up. So this is what that particular kind of a system looks. What are we trying to get to, really? What we're trying to get to is that EMAs by themselves, while they're very reliable for a lot of the things that we talked about in here, is not a trading system in and of itself. Generally, when a person tries to optimize, whether it be EMA crossovers or price crossing the EMA, you end up with a system that works for a very short period of time and ends up blowing you up in the long run. By themselves, moving averages are not a trading system. Let's talk more about EMA crossovers. So crossovers, both two moving averages and price to EMA, tend to work in trending markets and poorly in non-trending or choppy markets, as we just showed you. They generally should be combined with other price action or indicators to refine entries and eliminate signals when the market is choppy. Some traders have added a third moving average to help filter out false signals and reduce the number of entries and exits. This again shows you how that they're by in and of themselves, moving average crossovers are not necessarily a reliable trading system. Let's talk about EMAs for stops and exits. For those of you that don't know what a stop is, it's a stop loss. When you're in a trade and you're losing money, you have a price level where you've decided to stop the bleeding or stop the losses. That's what a stop is. So in the SMA module, we looked at how the moving averages can be used for support and resistance. And because of this, traders have used the moving averages for trailing stops and locations to exit trades. They may use a different set of rules to enter the trade that isn't based on moving averages, but then use the moving averages to exit the trade. EMAs are widely used due to their faster reaction to market movements versus simple moving averages. Exponential moving average as a trailing stop. How would that work? Well, here you see a sideways move in Litecoin, right? It's not much happening here, a little bit of up and down. There's a trend line here. This is a Path Trading Partners trend line, which is a very specific way of drawing a trend line. And here where this green arrow is, you get a close above, which signals a long trade. So what we're looking for here is a place to get out of the trade, and it's called a trailing stop. Trailing stop means you're going to follow price action higher and higher and trail where you would exit. So you need a method to do that. Here we're using the EMA in this example as the method, and we're waiting for price to close below the exponential moving average in order to exit this long trade. So here's the long trade. Here's the first area where price breaks it, but it doesn't close below it. Same thing with the low here. Now it creeps above the exponential moving average, stays above it for quite a while, and again, breaks it here, but does not close below it. Same thing there, same thing here, and the same thing here. Finally, all the way up here between 44 and 45 on price, you get a close below the exponential moving average. Not a trade below, but a close below. This signifies your exit. That's your trailing stop. So your exit and the place where you would stop out of your trade is the first time you get a close below the exponential moving average. What does that do for you? Well, if it develops into a trend, it gives you a very reliable place. It's where the trend may be weakening. This doesn't necessarily mean, as you saw in the price crossover method, that the trend is turning. Just means that it may be weakening because you've gotten a close on this Litecoin chart below it. So that's how somebody would use the EMA as a trailing stop. We found that waiting for a close beyond an EMA works best for a trailing stop instead of just price action breaking the EMA. Again, it's about choppiness. Now, don't over-optimize the length of the EMA to specific price action. Again, what that does is that makes you constantly optimizing the exponential moving average to current price action. That's not a sustainable way of doing things. Instead, use a variety of different price action and test the EMA strategy to determine a suitable length for the EMA trailing stop. So here's some tips on EMAs. Exponential moving averages react more quickly than simple moving averages to recent price action and therefore turn more quickly. In most of the trading and educating that Mike and I do, we put more importance on recent price action than on past price action. This can be both good and bad for the trader depending on the use of the EMA. Due to their quicker turning, they can provide more false signals if you're using them for trade entries. However, they will give quicker entries and exits if that's something that fits with your method of trading. We've found that if a trader wants to investigate using moving averages for entries, then they should also incorporate other tools into the system to reduce the false signals in non-trending markets. So in conclusion, this was the second installment of the moving average part in our tech series. If you have not watched the first one, you should, and then you should watch this one again. Understanding what's behind the different MAs will help you choose the best tool for your trading style. Just like the simple moving average, if you're investigating moving averages to incorporate them into your trading, start with looking at the most commonly used lengths, like the 10, 20, 50, 100, and 200 period moving averages. If you have decided to trade cryptos, it's very important that you learn about trading because they do respond in the same way that traditional markets do. One of the places you could do that is with us at Path Trading. There's a lot of free stuff on there. Follow us on Twitter at @path_trading. Like us on Facebook. And like I said, go to pathtradingpartners.com. Check out the free stuff. When you see instructional stuff on our website, whether it's for traditional markets or specifically for cryptos, the stuff still applies because markets are markets. If you can chart a market, you can make money in a market. Please visit us at our website. Sign up for the free stuff. Listen to our podcast, the Money Path podcast, which can also be found on the website. And you can check out a bunch of our blog articles, which are on there as well. Cheers, guys, and thanks for watching.